Nice, fantastic. Okay, guys. Well, Ollie, I really appreciate the kind introduction, and yeah, no, good to say hey, nice to see you all again. I've got some slides. I'll share them just to kind of keep me honest and make sure I don't go rambling off too much. Let me bring this up. If I maybe present that, I presume we're a Google Meet company, not a Zoom company. Can you see my screen in presentation mode? Yep. Fantastic. Okay, so Fuel Ventures inside the VC decision-making process. Jump in if you have questions at any point, just kind of ongoing, just shout. We don't need to be too formal, no hand up kind of stuff. We'll obviously have some time at the end to cover that off. But yeah, let's get stuck into it. Okay, so VC is actually a conceptually very simple proposition. So we're looking for exceptional teams solving, massive, significant pain points in big markets, and that's kind of it. I think it would be a bit of a shame to end the presentation there and say that's VC done. There's a bit more to it, but I basically want to go through some of the kind of decision-making points that we have internally that maybe are slightly less, publicized or less clear to the kind of the founder looking in from the other side of the table. And that kind of all revolves around how we evaluate essentially some of these three headline points on VC. Very quick introduction for those who don't know. So I'm going back a little bit before joining the Fuel team. So I started off at PwC for my sins. I used to audit financial institutions, which frankly just wasn't really my cup of tea. From there, a bit of a long story, I then ended up joining a craft brewery that had just trade exited into a big Japanese company. And yeah, the CFO made me a commercial role there. I was this kind of right-hand man, managing a huge amount of money coming into the business from the investment, scaling it, making it, big and mean and efficient, and ultimately integrating it into the bigger parent company. That was a pretty wild ride, lots of just all-round chaos, but very good fun. From there, I then joined a venture builder startup. So was there for almost 2 years, 18 months, 2 years. Helped them raise a seed round, did some interesting work with the portfolio founders that we had, commercial strategy and financial strategy, that kind of stuff. Eventually evolved into, some work on fundraising, decks, models, intros, that kind of stuff. Kept seeing Fuel Ventures everywhere I turned, so I figured looks a lot more fun at Fuel Ventures. I'll go join those guys. I joined the pre-seed team at Fuel, so I'm on the investments team over here. And yeah, to kind of give a little bit of context to Fuel Ventures, those who don't know, so founded by a chap called Mark Pearson in 2014, 15. He's an exited entrepreneur himself. He founded a marketplace company. It's called My Voucher Codes. Some of you may know it. And yeah, he exited that company, and then immediately wanted to get back into the game of working with startups. That was his thing that really kept him going. And yeah, founded Fuel sort of 2015 or so. 3 funds essentially. So we have a pre-seed fund, which is where I sit, an SCIS fund. So we invest early stage companies. We do pre-revenue, we do early revenue. Generally sector agnostic. We do lean heavily into kind of B2B kind of models. Then have a scale up fund, broadly similar, agnostic by sector, generally leading B2B, but we kind of have the latitude to invest in whatever sector we want, so long as we really like the team and the general thesis. And then from the scale up fund, we're doing kind of £1 to £4 million investments to give a sense of those kind of seed rounds, and then we can follow on up to Series A. That's the whistle stop. I will stop ruthlessly self-promoting and move on to value proposition, which I think is probably a bit more interesting. Okay, so these are kind of like, these next 2 slides are probably the 2 things that we think about first when we look at a company, when either at the deck or when they're pitching, or when we're just generally discussing it after a call as a team. And also worth thinking that I'm in the pre-seed team. All of my experience in VC is in pre-seed. This is probably skewed a little bit more towards pre-seed than it is at the seed and a Series A plus level. So if that's maybe take that with a pinch of context if you're at a slightly later stage. A founder said to me recently that we'd invested in, It was like a B2B SaaS founder. They're selling like a sales enablement tool. He was like, Mike, have you heard of this? The notion of painkiller versus vitamin. And it's basically, where when people are evaluating the value prop of a company as both a customer and an investor, it's this notion of, a vitamin is a bit nice to have. Vitamins, it will make you healthy and that's all well and good. But a painkiller is if you have pain, you need to stop that pain immediately. And you can't really choose if you take the painkiller or not. And that's been a kind of an adage for a while. I'm sure you've heard of it before. But he said actually where the market is at the moment, where he's trying to sell into, SMEs and small enterprise type companies on the B2B SaaS side, the decision-making process that his customers are facing is not, is this a painkiller or a vitamin? His customers are only investing in new tools and software as a customer if they have a broken leg, figuratively, and buying their software will help them strap this leg up and keep running. And this all comes down to must have, nice to have. So when you're talking to investors, you need to get across, first and foremost, to your customers, your product, tool, software, platform, whatever your company is building, is an absolute must-have to your customers. And you need to define, there's a lot of different ways to define that, a lot of different ways to present that. Based on what you're doing, who your customers are, your business model, this kind of stuff. But have this in the front of your mind that investors will be looking at being right. Is this a must-have or is this just a nice-to-have? Because when the push comes to shove, when the market tanks, when budgets are cut, when people are being laid off, all of your customers will be dropping anything. They'll be going through their budgets and they'll be dropping anything that's not absolute mission critical must-have. We need this tool. And they'll be getting rid of them. And the ones that are must-have, they'll keep them. Revenue pilots, LOIs, references, quotes. There's a bunch of different ways to do that at different stages. One that kind of particularly landed with me the other day, I saw to a company and a kind of building a vertical SaaS company, and he had a quote from there from it was like an email screenshot from a fairly high level person at one of his enterprise customer targets, and it just said, if I found out my competitor had this, I'd be really worried. And that's the exact kind of interesting way of capturing this sense of urgency and must-have. And this is a pre-revenue company, so there are different ways of going about it, even if you don't have paying customers. Not to dwell on this because I have got a bunch of slides. Moving on from must-have, nice-to-have, the kind of next thing, the next big thing that we will look at is ROI. And that's not ROI on our investment, but that's ROI from a customer's perspective. So if I'm a customer and I'm going to spend £100 a month, £10,000 a month, whatever, on this piece of software, what's my return? And more importantly, how do I measure it? And this is important, not just obviously when you're pitching to customers, as I'm sure you will do anyway, you consider this ROI component, but spelling out the ROI to an investor, angel or VC or otherwise, is super, super important. And most importantly, trying your absolute best to quantify it. We see a lot of, opening kind of problem slides and solution slides in decks where it's like, it takes a lot of time to do this, or companies spend a lot of money doing this, or they waste a lot of resources doing this. And that's generally when you're looking at, especially on a kind of a B2B focused business, it's increasing productivity, it's reducing headcount. The same amount of work can be done with a smaller headcount, or the same headcount to do more work. It's increasing sales, it's saving costs, whatever variation on what you're delivering, or doing the same at better margin. Any combination of those, really important that you frame that as, with our company, they're spending X amount of money on a software fee, they will save X, or they will generate X in new sales, and that as a kind of ratio of their investment in our company and their saving or their gain. And then obviously you want to show a huge gulf between them. Spelling that out is something we see so infrequently. So when we do see it spelled out with assumptions listed, and we see that narrative, that's when we are a customer thinking, oh well, we're going to be looking at this, and it's a no-brainer. I'm going to save 10 to 1 on what I'm spending on this. Why would I not? That's a really, really powerful thing that should be first and foremost in any kind of investor type conversation, from my perspective. Okay, valuation, runway, round size. So this is something that comes up a lot. As you're probably all very much aware, the dark art of pre-seed fundraising is, I'm an accountant by training, right? So when I first came into the industry, and I expected it'll be, DCFs and models and valuations that are, calculated in some of a more quantifiable way. And what I've quickly realized is how it works and how it has to work is it's a combination of the consideration of valuation, runway, and round size. Dilution, for lack of a better word. At pre-seed, with some allowances for exceptions, of course. If you're building whatever, we won't go into the exceptions just in a moment. 15 to 20% as a dilution for your round is pretty much on point. If you're doing a little bit of a smaller round, maybe we'll drop down to 13 or so percent dilution. But that 15 to 20%, there's nothing new there. That's a number that you've probably all seen a lot of times all over the internet from my conversation. Even in a bad market that we're in now at pre-seed, that has been somewhat insulated because ultimately, if you take a huge valuation discount at pre-seed, your cap table is kind of going to be screwed. And by that, I mean, pre-seed investors, fuel included, maybe VCs have a reputation for, pushing hard on valuations, pushing hard at deals. At pre-seed, it's not really in our interest to do a funding round at a crazy low valuation at a, 25, 30% dilution to the founder, because we know full well that you're going to have to go and raise a seed and an A and maybe even a B round before you have any prospect of exiting. Not every company will have to do that, but the kind of companies that Fuel and other VCs want to invest in, we expect them to have that trajectory of raising multiple rounds. If we hammer the company at pre-seed and we take a huge, low valuation and 30% of the company, then that just means that the founder is going to have almost nothing going into their Series A, B round, and that's not a strong cap table, and other investors will probably turn off by it. So the way we consider, okay, let's say 20% is our dilution number, and you want to raise £1 million. So £1 million, 20%, 4 million pre-money dilution, 5 million post-money dilution. So then it's like, okay, well, that's the 20%, Mike. You said 20%. I want to raise £1 million, therefore I'm valued at 4 million pre-money. So the dilution then comes in the context. We've got our dilution marker, then comes in the context of, does this company need £1 million? And can it justify a £4 million pre-money valuation? So the best way that we see founders explaining why they need the amount of money that they're raising is essentially, what metrics are they planning to go and raise their next round at seed, and showing a very good story, narrative from, I'm going to raise 500k, 600k, £1 million today, and I'm going to invest that across the course of the next 12, 18 months. And with that, I'm going to map out a clear product roadmap, sales roadmap, customer pipeline, all this stuff, to show that by month 18, I'll be doing seed level metrics. A big part of the challenge with valuations and runway and round size at the moment is that VCs are saying, we want to come in at sensible valuations, but we also want you to raise, 18 months runway. So if you're like, oh, well, to get the 18 months runway, I need to raise, £1 million, £1.5 million. But then at the same time, to get the 18 months runway, but at the same time, at 20% dilution, that's going to value company at £4 or £5 million pre-money. But then if you're a very early stage company, then we couldn't necessarily justify a valuation of £4 or £5 million. So it's all about thinking about metrics and bridging and getting to that next round and having that clear narrative in terms of, if I raise 500k now, this is what I plan to do with it, and this is the position I plan to be when I go out to raise next. Uplifts are a big part of how we consider valuations also, because ultimately we want to invest in companies that we have a chance of returning 40, 50, 60, 100 times our initial investment on. We're only going to be looking at companies where we think, right, this could go to multi-100 million pound valuation is like the hard truth of it. That will rule us out of a bunch of companies and a bunch of potential investments that, you know, these companies could build a really robust business, profitable, free cash flow, and, you know, they could maybe get a trade exit 30, 40, 50, 60 million pounds. Our whole thesis and our fund economics is that we need to invest in companies that have the prospect of hitting hundreds of millions of pounds in exit valuation. And if we don't swing big and we don't go for those, then yeah, we're not going to get them. So if you have, yeah, that's kind of needs to be considered in the entry valuation we pay to. You know, if we're paying a low valuation, then we're going to be much easier able to return a 50x 50x return on the initial investment. If we enter at a 15 million pound investment, exiting at 100 million, we're only going to be getting like a 10x on our initial investment. If we exit 100 million and we initially invest at 2 million, there's going to be a 50x. So that's the same exit valuation, but two very different entry prices, which has two very different impacts on our return profile. I won't get bogged down too much more in this. I think if there are specific questions, let's maybe dig into them. But on to the next slide, conscious of time. Okay, team. So at the pre-seed level, team is, I know we spoke about value proposition, we spoke about ROI, but in terms of like the bare bones of, what we're looking at, and bearing in mind, we're often looking at companies who are investing, companies who are pre-revenue, very early revenue, sometimes even concept stage. So really what we're investing in is the team's ability to not just get from their pre-seed round to the next round, but do we think this is a team that can build a company, as I mentioned, that has the possibility of getting to multi-100 million pound exit potential. Not every founder is necessarily going to have to therefore be viewed through the lens of, do I see this founder as a potential future CEO or CTO of a multi-100 million pound company? Not necessarily. Like along the way, there's definitely lots of different people you can bring in and ways you can diffuse skills, but at least to some degree, we need to think that the founder has the drive and capability to execute and to sell their vision, not just to investors and not just to customers, but to sell their vision to other employees who are much smarter than them and that are going to be able to attract them into their company to take them forward. So if you're pitching and like, frankly, because let's be frank here, why not? If we don't get the sense that you could walk into a room and attract a hard-hitting, CMO, a hard-hitting CTO, a hard-hitting, head of sales, whatever the role is, because we don't necessarily think that you're able to articulate your big vision, then it immediately becomes a challenge, because we're like, you're going to probably struggle. If you're struggling to get us excited, you may struggle to attract the top tier talent. That's unfortunately a big part of what we look at pre-seed, that ability to sell yourself and sell the company. Another thing we look at is balance. So we do invest in solo founders. I think there is not a problem with solo founders, and I've worked in a venture builder where we specifically work with often solo or sometimes multi but non-technical founders. I personally don't think this is a particular problem at the pre-seed level. When you're gearing up to go towards a seed round, if you're using some kind of agency, some kind of fractional CTO, this is specifically on the tech side, they're using some kind of not fully bought in tech lead at the seed level, if you're looking to go out and raise a competitive seed round from a good fund, in our experience, and I've seen this a lot of times, seed investors are going to not look at that favorably. So I'm absolutely not saying you're an early stage company, you're a pre-seed company, or you're just getting going, you're a non-technical founder, you should go and give a slug of equity away and bring a CTO in. I'm not saying that. But I am saying as you're gearing up into that seed round, know full well that the question will come that you're building a tech company, especially if you're selling to bigger companies, enterprise customers who are going to be very demanding on you. We've seen, and these seed investors have also seen, if you don't have some kind of tech competency in-house, you're going to struggle to be able to pivot to the demands of your customers, pivot to the demands of and the needs of the company if you don't have that in-house. That's our position on it. I know there's lots of other positions in the market, and there's probably a bunch of competing positions even on this call. But that's our take on it. I guess the final piece around team, we in the pre-seed level, we often look for experience around building. So obviously, if you're a previous time entrepreneur or you're an exit entrepreneur, that's fine, tick box, that's fairly easy. But we also look, and when you're presenting to investors, think back, if you're a first-time entrepreneur, for example, think back to, are there instances where I have built something? So that could even be within a previous organization. That could even be you were part of an enterprise kind of company and you built a team, you built a business, you built and scaled something, even if it's within an existing infrastructure. The data says, and there's a book called Super Founders. I don't know, maybe you've come across it. Wholeheartedly would recommend reading it. It's very interesting, very interesting read. They talk a lot about experience of building, the mindset of building, the mindset of taking something and making it bigger. Even if that's not within your own company, think back through your career, through your combined experiences as a team, and really highlight, hey, look, we have built stuff before. If you have that, if you don't, kind of is what it is. But if you do have that somewhere in your track record, I would very much recommend shouting about it. Business model, just checking how many slides here. Okay, let me rattle through these ones relatively quickly. Apologies for the getting bogged down a bit earlier on. Business model in the current market, B2B is king. At pre-seed, at scale up, at seed level, at Series A, investors, VCs, are not investing in B2C companies. Apologies if you're building a B2C company, and that's a tough thing to hear on a Friday morning, but that is to a large degree the case. And if you've been talking to investors already, you probably know that that's the case as well. So, with that information, kind of do what you wish. If there are B2B2C angles or B2B2C pivots that you can make on a pure play B2C company or business model, I would recommend exploring them, because if you are chasing B2C business model, there's a fairly narrow pool of investors who are funding those types of companies at the moment. And I expect that will continue over the next 12, 18 months. That's my take on the market at the moment. Obviously, great founders solving big problems in big markets with B2C model can always get funding if they hit those three criteria. But the bar is high, to be perfectly honest. Marketplaces, a sense that I'm getting at not just pre-seed, but seed and Series A beyond, is that marketplaces are extremely hard business models to execute. Mark, our founder, he's an exited marketplace founder. We have a lot of marketplaces in our portfolio as well that we've invested in at pre-seed, that we invested in at the seed level, and have got follow-on funding. But there are also some marketplace models that are hitting really robust metrics at the seed level and are going out to market at Series A and seemingly struggling. So this is a direct report from, if you're building a marketplace model, you need to enable yourself a lot more time to go out for VC funding, because they're not necessarily in vogue at the moment. When things in the fundraising environment get difficult, people seem to revert to SaaS. SaaS is, easy to a degree, easy not to execute, but easy to evaluate as an investor. You have recurring revenues, you can have all the metrics below, you can talk about repeatability of customers and LTVs and different kind of CAC and LTV metrics. Investors like SaaS. That's And at the moment, they like SaaS more than they used to. Over the last couple of years, marketplaces were very much in vogue. But yeah, my honest take from the market at the moment, marketplaces are hard. They're hard models to get investors excited about. On the metric side of things, when you're building your business model, yeah, okay, I won't run through all of these at the moment. They're all fairly self-explanatory, but as a minimum, your average contract value, your annual contract value, your customer acquisition, your lifetime value, these kind of metrics at bare bones have a sense of how you calculate them, how they evolve going forward, how they are pre-receiving funding, post-receiving funding, how they can improve. I won't throw any numbers down. Different metrics are, they'll have different, criteria and points at different stages and different business models. But at a minimum, I'd say these are very good ones to have your hands on. Decks, okay. Decks are important. I know people probably think that, why am I going to spend all my time designing a deck? And me being able to design a nice deck has no read or impact on my ability to build, run, grow a fantastic company. And I am totally in agreement with that. But that's just not how the status quo is. If I see a deck that's been made in PowerPoint and has, excuse my French, just crap design and is, just been pulled together in PowerPoint by, someone who's not particularly design focused, my immediate thought is, okay, they haven't got a read on what their investors want. They haven't got a read on the fact that the bar is extremely high and we see a lot of very, very high quality decks. Are they doing the same approach with their customers? Like when they're selling to them, when they're presenting to them, like how are they generally packaging things up? Like we will generally, wrongly, to be perfectly honest, but this is how it happens, extrapolate a bad deck probably means there's some other things in the founder's mindset they haven't quite nailed down yet, from a pure like outward how you sell your company. And this is a market where selling is everything. You're selling to investors, you're selling to customers, you're selling to employees. So if you have a bad deck, that is bad news. I kind of just wrote down a bunch of random things. 15 slides, don't get more than that. It won't get read. Or it will get skimmed through. You're wasting your time. Focus on 15 slide maximum. If you want to have more detail in the appendix, absolutely go for it. I've got no problem with that at all. Design narrative is important. Get a professional designer, or at worst, use Canva. There are a lot of design tools out there to use. I could not recommend more not using Google Slides or PowerPoint on their own. Make sure you link to the founder LinkedIn's and the team slide, bit of a pet peeve of mine, so I can click on it straight away and go your LinkedIn. That's kind of just a small kind of thing. Link to a demo video, I think is always very helpful. Have an appendix, impact slide, have an impact slide early on, first or second slide, essentially executive summary. If I read nothing more than your deck, other than, this is what we're doing, this is who we are, this is what we've achieved so far, then if I can come away from the deck knowing that all on one slide, all the better. I put Notion here in capitals. The best founders that I see have a Notion page with essentially an investor FAQ, links to more information, kind of, appendices type stuff. And, they kind of break down in a lot more detail than you can go into in a deck. The best founders I see have Notion slides. Get a Notion page, and investors will genuinely think, okay, this founder definitely knows like the game. Financial model, okay, that was the last one. Financial model, super quick. Financial models are important even at pre-seed where all the numbers are made up. I love a financial model, accountant obviously, so maybe I'm a bit biased towards that. Shows us how you think, shows us how you can understand, the commercial levers that you have to pull. If we're about to give you a load of money, we want to understand very much, are you going to be able to spend this responsibly? And are you going to be able to generate, good ROI, not just for yourselves, but for us, most importantly. Sensibly ambitious, like that's completely meaningless. Yes, to a degree, but I think we are investing in venture scale companies who want to achieve multiple funding rounds at huge valuations and exit for hundreds of millions. If you're presenting a financial model that the year 5 number says we'll be doing 6 million revenue, 8 million, 10 million revenue, I'll be like, that's great. It looks like a really good business and good luck with it. That is not a venture backable business. In year 5, rule of thumb, think, can I get to 30 million quid in revenue at not necessarily a minimum, but I think that's a generally good target. And if you don't think you can with multiple funding rounds, expanding into different markets, then maybe the business model needs to slightly tweak. But don't start sending models with 100 million year 5, because there's this fine line between ambition and sensible and just a little bit off whack. So I will leave you with sensibly ambitious on the models to interpret as you wish, but knowing full well that I want to see someone going after a really, really big market and a big business. I will leave things there. Ollie, appreciate I've run over by a few minutes, so I don't want to completely kibosh your session. How do I stop sharing this? Over to you, Ollie. I don't know if anyone has any questions that I appreciate I kind of ran through relatively quickly.
That was fantastic. Any questions for Mike? I've got one, but we'll see if there's any questions from the our founders community first. Tom.
Mike, that was fascinating on a number of levels. And I think my sort of response to things was changing as you were going through things. I was particularly interested in your slide about the decks, not about necessarily the decks themselves, but about the sensibility for founders. I love this idea that you are looking closely for people who can read the room, and that extrapolation that you talked about, saying, well, if they can't see, if they can't see that's a bad deck compared to most, if they can't see that's not what we want, if they can't see, you know, and then how you would take, okay, well, they probably can't see this, that, and the other. The interesting thing is founders have spent weeks, months, years stuck inside their own heads, doing all that first principles thinking, doing all that design. We've all sort of been in a very small box. For you, what's more important? Which is the more fixable attribute? The founder who you think, okay, they've been stuck inside their own head for too long, but we can probably fix that. Or the person, if you think they seem to have no, you know, sensibility to the wider world. Yeah. Which is the thing you can fix and which is the one you can't, or you know?
Yeah, no, it's a really good question. And I appreciate some of what I said in this call might be a bit controversial because it was blunt and it was honest, and you know, apologies, but also not, you know, that's how it is. The instinct, or an instinct take on your question, is if you put yourself in the footsteps of a VC, and very, very different for angel investors. Let's make it abundantly clear now, angel investors and VCs are very different beasts. They have their pros and cons on both sides. A VC, me, for example, at a reasonably popular early stage fund, you know, we'll do 30, 40 investments from our pre-seed fund this year, for example. We receive hundreds and hundreds and hundreds and hundreds of decks a month, thousands a year. When a deck hits me, if it comes from a warm source, again, rightly or wrongly, this is how it works. If it comes from someone I know, if it comes from a founder I know, if it comes from an ecosystem person I know, comes from someone who's like, Mike, I know the founder, I've spoken to the founder, you should have a chat with them, they're building something interesting. I will always take an extra bit of time to give that deck the benefit of the doubt. If a deck hits me in a slightly more cold way, you know, it's put in front of me, I don't have time to work out, can this to find the diamond in the rough. Make your life easy for your VC, who's probably going to spend 1 or 2 minutes skimming one of the hundreds of decks they have. Every minute extra that they spend on one deck is an opportunity cost of a minute that they can't look at another deck. Again, I'm not saying at all that is how the model should work. It's not. That's broken. But I'm not here to fix VC. I'm here saying everyone I know has a slammed inbox. And when you're receiving things cold, if you have something that doesn't look right, you're making your life as a founder really tough to break through into the small part of the funnel that actually receives that second call and the funding. Appreciate I didn't massively answer your question. I ranted a little bit, but I hope that was useful nonetheless.
It was. I mean, what it shows is that it doesn't really matter who we're all sort of, I suppose, in a way, victim to our own cognitive processes. And that's the thing, is it's important for founders to understand the cognitive processes of someone in your shoes. I think what you said about, I'm not here to fix the model is entirely the thing, because I think some founders go in there kind of expecting to get some kind of special treatment or thing, and we have to understand this is the way it is, or go somewhere else.
And that's where angel investors are such an enormously valuable part of the ecosystem, because from the experience of some of the ones I've worked with, they do have, whether the time, capacity, or just general willingness to work with a founder, to build them up, to grow them and develop them. That's why angel investors are such a crucial part of this network, this industry.
Great, thank you, Mike.
No Thanks, Tom. Phil.
Good morning, Ollie. Good morning, everybody, and good morning, Mike.
Hey, Phil. Good to see you.
Thoughts, questions are around, to put it bluntly, most founders fail. It might take them some more time than others, but most will fail. And angel investing takes some of the risk off the table for VCs. But even when a VC invests in a company, a fair chunk of those will fail too. So, I mean, do you think there will come a time when things like psychometrics or personality testing will feature in the decisions that VCs will make? Or do you think you'll stay with the kind of, what was part of your answer to Tom, is that you won't even have time to do that? It will be, I'll give this one a minute, and if they don't make the good impression, then I won't go any further.
I'm not fairly sure, but I do think I've read somewhere that at later stage funds writing huge tickets that are 10, 15 plus £1 million tickets, they're doing a few deals a year, they can take weeks to do proper due diligence. I'm pretty sure I've heard of them doing that exact thing you mentioned there, doing psychometric tests, understanding. At pre-seed, that's an almost non-starter, the volume that we have to work at. Imagine if a really top-tier founder came to me and I was like, oh, can you just do this psychometric test? Unless the entire industry moved that way as a fixed standard, which I cannot see happening at all, that's not going to happen. At pre-seed, no. At seed, probably not. At later stages, huge tickets and lower frequency, I think it probably does happen to a degree, but I would suspect it's still very much not the norm. We look for other quicker indicators. And also doing a psychometric test, unless you do it in a properly controlled, regulated environment, if you send a founder a link, they can put in whatever they want, unless they do a 1, 2, 3 hour long test. If you ask a founder to do a 1, 2, 3 hour long test, I'll say, Mike, appreciate you have your methods, but I'm not gonna spend that time doing your test. Thanks, goodbye. That's my take.
Okay. Thanks very much.
Thanks, Phil. Wesley.
Right, brilliant, excellent. Well, first of all, I have to say, well done, Mike. That was a really excellent presentation. And
thank you very much.
Yeah, I've raised 407 million in my career.
And that's a lot of money.
Yeah, it is. You've answered quite a few things there, actually, which is interesting. I'm still learning all the time, and you get your knockbacks on a regular basis. So my question really is what's the best way in the current market, because I've not seen a market this bad before. I mean, it's just the UK market I'm referring to, because the EU and the North American market seems to be active. And the feedback I've been getting is that VCs in the UK are not really following the US and EU anymore. So it's a kind of, we're on our own scenario. So my question really comes down to is, we're ahead of the curve with what we're doing. And what we're finding is a lot of VCs don't really understand how AI is evolving and where it's going to evolve to in 2 or 3 years' time, and how it's going to break up and into individual industries, etc. What's the best way, in your experience, would you say, to get that across to a VC? Because we've had various different changes on our deck that has made it attractive, and we're constantly changing it, actually, Mike. It's not something that, so it doesn't stay static. We have different things. And interesting thing for me is, in my career, I've always raised big money for big things. So this is lower end money that I'm raising. But just yesterday, PricewaterhouseCoopers said to me, look, Wes, move away from this seed stuff. Just get the Series A. Go for the big money now, because you're clearly hitting some ignorance in the seedy area, and that is true. That's what I'm seeing. So I kind of, in a roundabout way, trying to ask you, how do you convince or try to educate without sounding patronizing to a VC?
Sure. Instant question. Okay, a few bits to it.
Yeah,
Was
sorry.
no, all good. Was that the PwC Raise team?
Yeah.
Was that like Ed and co?
I can't remember the chap's name, but
yeah. Okay, so question without giving too much away about your business, but yes or no, are you doing more than £1.5 million ARR currently?
No.
In SaaS? Then what he's told you or she's told you there is absolute hogwash. Do not go out for a Series A tomorrow unless you're doing more than, one and a, like the adage used to be £1 million ARR was the Series A metric in the kind of B2B SaaS world at a reasonable unit economics, 70+% gross margin.
Yeah.
If you're not, that has shifted now in the UK market, a little bit different than the US, always has been, but that's not my area of expertise. I won't speculate. Frankly, neither's the European market. I know about the European market reasonably well. The Series A metric is pushing north of $1 million ARR, £1.5 million ARR is kind of now the starting point in those conversations. If that person said to you, go and raise a Series A, and you're not doing that, then they've done you a disservice, and you're going to spend 6 months preparing for a round that you will never land.
Yeah.
Is there an exception to that? Yes. And without knowing too much about your business as well, hardcore AI kind of stuff, if it's very deep IP stuff, look, there's always going to be exceptions. I'm still fairly confident that if you've not been able to convince or persuade or entice earlier stage investors to get your business, going in at bigger investors who do fewer deals at bigger tickets and more scrutiny, probably not going to get it. It's going to be hard. So that's one point. I totally agree with you and hear you on the point of saying you're an expert in this subject and this business, and you've been building it for however long number of years, you know it inside and out. You're talking to VCs and they're like, I don't get it. VCs are sometimes really great funds, absolute subject matter experts in their field, and they're going to have a very specific thesis and very specific experiences and sectors. Sometimes they are just schmucks like me, or worse, they're consultants or they're bankers or they're just general, they've not, at least I've had a degree of working in actual companies and I've, being an operator and understanding commercial stuff, but I'm not going to sit here at all and pretend that I'm an expert in AI, because I'm not at all. So it's a case of dumbing down where possible, at least in the early stages. This is a thing that is solving a big problem that customers want. Customers are either paying for me now, paying me for my service now, or I have indications that they will. I've got metrics to imply that they will be paying for it once I hit a certain product roadmap. And you need to build a narrative that way. Is that the right way? Not necessarily, but is that the way the VC industry works? Do you have customers with big pay points willing to pay you lots of money for you to solve it? Appreciate that if you're saying your business model itself is molding around, like maybe, and could not recommend that more, iterating your business model until you find something that works. But I guess my question to you is, are you iterating your model because that's something that works for your customers, or are you iterating your model because that's something that VCs want? It should always be the former. You should not be iterating your business model to match something that the VCs want. If you want to build a really fantastic company, you should be iterating something that your customers want. And then if the customers come, then the VCs will hopefully eventually follow.
Yeah. I mean, we're in this runaround where we need to bring in as much data as possible for what we're doing. Sure. So in my initiative, I thought, well, what we do is we'll put some lifetime deals into place. In order to, why not earn some money from? We need customers, we need users. So rather than giving it all away for free, we're going to get customers in, and we'll earn a bit of revenue from that. And that's come back to backfire us, to shoot us in the back, effectively. Because now what the VCs say, oh yeah, but you're not on the MRR, you've got to switch. Well, yeah, but you're missing the point. You're looking at the revenue, not actually what we're trying to do. We've got to get the data. We need the volume of users in order to get the data. So what we've done is actually very clever. We've generated a revenue source. Anyway, listen, I won't go into too much detail. You've answered kind of what I thought you were going to say anyway, to be honest. But it's been a very, very good presentation, and I can't thank you enough for doing it.
No problem. Yeah, happy to chat afterwards. If you've got any follow-ups, drop me a LinkedIn or whatever.
Thanks, awesome. Wesley. Neil.
Hi, yeah, thanks, Mike. Great presentation. I'm a product, service, and experience designer, and I found it fascinating from your perspective, from the VC side, about how important, I guess, the first impression is about understanding what this looks like, and also that the product or service doesn't necessarily feel homemade. And I've looked at a lot of decks, and even though there might be a brilliant idea behind it, selling it, if you don't actually kind of see what it could feel like, is so much harder. I have the challenge when I talk to, founders about, create the smoke and mirrors prototype, do the thing that make people fall in love with. My new favorite term is minimum lovable product rather than viable. Is to, how would you convince, or how would you sell to a founder saying, look, it's worth investing in this. This is not marketing. This is not sales. If you don't design your business and design the product and service and experience that you want to sell, you're not going to get the investment, or you're not going to get as much investment. How would you go about kind of trying to, encourage founders to go down that?
Sure. No, I understand where you're going with the question. So, I've had this conversation before, a variant of it, and I contextualize it as, even with a boring compliance tech B2B SaaS company. By the way, I say boring in a very endearing term. I love investing in boring companies, but boring in terms of, nothing particularly exciting or consumer facing. Ultimately, the person using that piece of software at the enterprise or the company who's paid for their license, who's sitting at their desk on a Monday morning, if they're in the company, the software itself is only really good if the people who need to use it engage with it. And let's say he's called Neil, who's sitting at his desk using this piece of boring compliance tech software. This person is used to using Airbnb, Netflix, Amazon, Spotify, all of these in their regular life. And they're now expecting that level of ease and usability is going to follow them every other place they go. If they go to work and they're left with this clunky 90s design, outdated software, they're not going to use it. They're not going to engage with it. If they don't engage with it, it's never going to grow within the company. The company's going to be like, oh, people aren't using your software, we're going to can your license. So contextualize it as, in every facet of everyone's life, they are using top tier user experience, design forward products and tools. That expectation, fortunately or unfortunately, depending on who you are, has carried into the B2B side too. And there's the expectation that your software, your boring accounting software, is as easy and delightful to use as Spotify or Tinder or whatever example you want to use. That's probably a way of framing it, and I've had that conversation before. Hope that's helpful. Maybe.
No, indeed. I mean, the expectation. I've worked for a lot of big companies, not bad, big, although they might have been at certain times. And the internet's just been shocking. And they ask you to kind of have a culture, to get involved in the internal culture. And nobody does, because it just feels like you're using a back end system. So yeah, I mean, I guess the first people you need to sell a customer to, or your brand to, is the people that work there. The people
Absolutely. Obviously, it has to do all the other stuff too. As a VC, I'm like, oh yeah, I want it to be functional, but also look really good.
Mm-hmm.
Just do it, founder. I know that is obviously very difficult and expensive and yada, 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 yada. But unfortunately, that's what your customers are probably going to be wanting to a degree.
Brilliant. Thank you. It's not as expensive as you might think. But anyway.
Good stuff.
Thanks, Neil. Any last questions from Mike whilst he's with us this morning? Johnny.
Hi, Mike. Great presentation. Absolutely. You are beyond your years. It's shocking how young you look, and the level
I will
of
take that as a compliment, Johnny.
It's a very big compliment. You are incredibly competent. PwC definitely helped you a bit out there, I think. So we did things a bit in reverse with our third business. We went and met with one of the, I think he's in the top 6 tech investors globally. I just said, oh, I've got this idea. What do you think to that? And he went, oh, let's build it. How much do we need? Let's get these guys to put 10 million in, and then we'll get someone else to put 50 million in and scale it. And so I did everything backwards. Do you find, I'd love to hear your kind of experiences on stuff like that happens, and maybe some of the tales of where it goes wrong, because I've got lots of wonderful legal people around me giving me advice. Get him to sign this, get him to sign that, make sure that he doesn't steal it all. It's obviously a great idea, or you wouldn't even be in this position. So Any advice on people who do it backwards and they get the money before they get the pitch deck done?
This has happened a very small number of times with us, and yeah, maybe I'll give the pre-seed and seed kind of lens on it. If you've built something before, and by built generally I mean exited a company before in a loosely similar space, that could be as loose as a technology business, then you will have much higher likelihood of a VC win to take that chance with an idea on a napkin. Maybe you put that into the form of a slideshow, but before pre-product. Investing pre-product, you have to really, really, really believe that the founder can execute it. And generally, to believe the founders execute it, they have to have done something fairly exceptional. Look, fantastic that it sounds like you're able to convince someone with 10 million quid to give you 10 million quid at an idea stage. I would, maybe it's just my accounting mind, would be so unbelievably anxious about going down a journey like that, given that starting from 0 and going to 10 million, you're pumping fuel on a fire that you don't know if that fire is burning the right shape, size, color. You're just pumping 10 million quid into it, and you're using that money to iterate and expand and learn as you go. Obviously, if you're an experienced founder with a fantastic network and you know exactly what you're doing and you've done it before to a degree, and this is a company's a variation of it, you have a very specific plan. Okay, you know, that's a nuance that can work. But yeah, I'm generally fairly against founders raising even big, when I say big, £2 million rounds, seed rounds at the pre-revenue stage or early product stage. One, because as a VC, if there's a £2 million round at pre-product, and that ultimately will be a 20% dilution at £10 million post-money valuation, to get, if that company exits at a 100 million exit, which isn't great but isn't bad, and I've come in at 10 million, if you factor in dilution, I'll probably get like a 5x, 6x return on that. So even at 2 million, the company needs to, a £2 million round, the company needs to exit for quite a big valuation to get any kind of meaningful return on it for the risk that I'm taking coming in pre-product. If you raise 10 million at, depending, but let's say a 50, 60, 70 million pound valuation, call it 50 million pound valuation. If you exit for £500 million, then I'm only getting 10 times my money. And I came in pre-product, very early doors. And it's going to be less than 10 times because there'll be more dilution coming in. So I'll probably get 5 or 6 times my money. If you exit for £500 million, do you know how many companies exit for £500 million every year? I tell you, it's not that many. If I want to get a 15, 20x of return on my investment, which is kind of bare bones, early stage, VC expectations, you need to exit for a multi-billion exit. I don't need to tell you how tricky that is. So for me, that's never going to be something I'm ever going to touch. Best of luck, you, Johnny. Don't ever send me that deck with that request. And yeah, good luck.
That's really interesting. I'm trying to work out the psychology there of that. I won't touch anything unless it gives me 10 times the amount that I put in it.
Minimum at
That's
pre-seed.
interesting.
Minimum.
That's interesting.
That's not a good exit. 10x is not a great exit because I'm going to have 10 investments. 9 of them, well, 5 of them are probably going to go to zero. A few of them are probably
so if you invest,
and 1 or 2 of them will go big.
So let's say you invest 100,000 in something and you get £1 million out of it, let's say, or $1 million plus the investment. You would see that as a bad investment.
So not necessarily as a bad investment, but if you think about, so let's say I'm making 30 investments a year and, 5 or 6 of them are going to go to absolute zero. 2 or 3 of them are probably going to go to between 0.5 and 1.5 or 2x return. And then one of them, maybe if I'm lucky, one of them will give me a bigger return. The ones that do return, so if I'm making 30 investments, that's 3 in my portfolio are going to, hopefully do very well and do the 100+ million exit. I need the exits that do happen to pay for the 25 that don't. So if I'm making 10x, because I have to return my portfolio, not just one investment at a time. I can't look at the other 9 that haven't performed and look at the one that does. I need the one that does to pay for all of the other investments that for whatever reason, whether they were bad investments, bad markets, whatever, didn't work out. So yeah, a 10x at pre-seed, like that's gonna just about wash its face. And obviously, I'd love a 10x. You give one tomorrow, but really, we need much big ones. Phil Mazzini, the power law, got it in one. I probably should have just said that.
Las Vegas on steroids.
Exactly.
Thanks, Johnny. Thank you very much, Johnny. Andrea.
Hi, Mike. It's good to know that some things haven't changed. I worked for Benchmark Capital earlier this century, and the business plans used to come in. We'd send them a letter thanking them and say we'd be in touch if there was any interest, and they sat in a drawer. Nobody ever read them, which I used to think was shameful. Anyway, and it was also very much who you knew, whether you got FaceTime or not. So nothing changed.
I like to think that is changing, probably slower than it should. I do like to think that is changing. For example, like if any of you guys happen to reach out afterwards, or if this was at an event or at some other similar, then it's a lot easier to connect with people now, just given tech. But you're totally right. Like some kind of warm introduction, it's been the same for the last 500 years, and it probably won't massively change, or at least won't change as quickly as it should do.
Well, this is just a quick question, because I see we're running out of time. Knowing what you know about the back room, are you tempted to go back onto the front end and be an entrepreneur again, or do you consider?
So just to be super clear, I've worked at a couple of kind of earlier stage companies, especially in the context of going from PwC, kind of a scale up that a trade exited, and a startup that raised a seed round, but more as an operator. I've never taken the plunge, taken the risk. I don't know how entrepreneurs do it, to be perfectly honest. It fills me with anxiety waking up and being like, gosh, I'm running my own business. I do like to think that I'll one day go to a company, a startup, scale up. What state it is, I don't know. I do like the notion of building and being in something that's fast moving and early and exciting. Do I ever see myself doing that as an entrepreneur, being the person to lead that charge from day one? Not sure. Maybe if the right idea and co-founder came along.
Right. Thank you.
Thanks, Andrea. Mike, that's been fantastic. Any final questions for Mike? Whilst, Stacey.
You were talking earlier in the very beginning about energy.
Mm-hmm.
How do you discern energy of somebody who's really passionate and knows and can dig deep, and the bullshitter?
Yeah, that's a really good question. We see lots of people who tick both those boxes. At pre-seed, when we're doing a lot of deals at once, at pre-seed we're doing a lot of deals at once, we don't have time to go and spend 2-3 meetings in person to really get to know somebody. I think it's probably a bit of a stretch to be like, oh, we've developed the fine art of bullshit detection. I think actually that's a very difficult thing to do, and even extremely smart people will get tripped up by that. So I'm not sitting here being like, oh, I talk to lots of founders, so I can therefore immediately tell when someone's bullshit or it's not. If it's very early, it's proofs in the pudding. Do they have anything to back up what they're saying? Are there any metrics or any quantifiable things we can look at? Are there any customers we can talk about? Are there any employees or co-founders? Have they been able to attract other people into their sphere of bullshit? And if they that's a very hard thing to build past a certain point. If it's just a founder in a room bullshitting, saying, this and this, great, we'll ask for the receipts. And if they can't show us anything and we get a sense that maybe they're overstretching, then we'd rather call bullshit on it. 9 times out of 10 it probably is, and we'll gladly miss it 9 times, and then we'd gladly call it bullshit 9 times and miss the one time it's greatness masquerading as bullshit, than we would invest in the bullshit. I think I've got a bit lost my own analogy there, but I hope that broadly makes sense.
Perhaps there's too much bullshit there, Mike.
Yes, sorry, I know we're recording this. I actually need to run. I've got a founder call, and it's always a real tough one to leave founders waiting. But guys, I really appreciate the time. And reach out on LinkedIn or email. I'm sure Ollie's got my details. Ollie, feel free to share my email with the team.
And please share your slides with us as well, Mike. Thank you very much. You're going to get a lot of love and big ups on LinkedIn today.
Fantastic. Appreciate it. Cheers, guys. Bye now.
Welcome.